Today we're getting into a fresh Dan Ives interview that every AI and tech investor needs to hear right now. Dan Ives, the global head of tech research at 𝗣𝗟 Securities, was on CNBC's Fast Money talking about what he sees coming next for the AI trade, and he did not hold back. His big message was simple and powerful. This is just the next stage of the AI revolution. On top of that, he's calling for tech to be headed up 20 to 25% in 2026. As you know, I'm going to play you the clip of Dan Ives on CNBC. Right after that, I'm going to break down exactly what he said, what it means for the market, and what I think most people are missing when they hear these kinds of predictions. And then I'm going to take it a step further and give you an in-depth analysis of two brilliant AI stocks to buy right now, based on the same themes Dan Ives is pointing to. Now do me a favor, hit the like button, share the video, and drop your thoughts in the comments. And if you want to stay ahead of the next important investing update, subscribe to the channel so you do not miss what's coming. Alright, let's hear what Dan Ives has to say.
Dan Ives joins us in person, in studio, a global head of tech research at 𝗣𝗟 Securities, and Arjun is also going to join for the conversation. Dan, fantastic to see you in the flesh. Thank you for stopping in. Yeah. Well, let me kick off with a broad brush question as we head into 2026. I think many would describe you as a perma bull on the tech sector in the U.S. Anything change heading into 2026? Or still pretty bullish on the space?
Look, the reality is it's still 10:30 p.m. that AI party that goes to 4 a.m. Because look, in my view, when you look at this AI revolution, it's now going to the second, third, fourth derivatives. It's software, cybersecurity, infrastructure, power. And look, I think the bears, they're just going to continue to watch this party from the outside looking through the windows.
Is it the hyperscalers that are going to continue to lead the AI trade, or are we going to see more diversification into other layers in 2026?
Yeah, look, it all starts with godfather of AI, Jensen, Nvidia, and now getting back into China. That's just another pop the champagne moment for them. But then you look at hyperscalers, you look at Microsoft, you look at everything that happened in Alphabet, Google. I mean, that's really been a massive turnaround story, right? I mean, I'd say the cab driver here in London was bearish on Google going into in the beginning of the year. Now, I mean, you're seeing it because, and I think you're just starting to see that in Amazon as well. But look, it's now going to spread use cases. That's why 𝗣𝗟𝗨𝗦𝗧 in terms of what we're seeing there, MongoDB, Snowflake. I think that's going to be the trend here as the derivative beneficiaries of AI spread.
Dan, given that thesis on the derivatives, how much longer do you think this tech bull run has to go?
2 more years.
2 more years.
I mean, and I think that's conservative.
Yeah.
I believe we're going to be talking about NASDAQ 25,000, 30,000 over the next 12, 18, 24 months. Look, this is a fourth industrial revolution. And as someone like myself that covered tech stock in the late 90s, you'll hear all the comparisons. It's apples to oranges. We're talking about humanoid robotics, autonomous. The consumer AI revolution hasn't even started. That's going to go through Cupertino. I think that's why you're seeing Apple make those major changes. And now you're seeing a cooling of tensions between the U.S. and China. That's bullish in terms of this AI trade.
Dan, in terms of 2 years, then sort of what, I guess, sort of pulls back that bull run? What derails it to some extent, in these cycles that we see in markets?
Yeah, look, we're going to have these white knuckle moments. I mean, you're talking about DeepSeek moment, Liberation Day, U.S.-China, in terms of some of the sort of back and forth. Nvidia, can they go into the U.S.? Can they go from U.S. into China or not? But look, those white knuckle moments, those just create the opportunities to own the winners in AI. And that continues to be our view. Call it perma bullish, but the reality is I think investors are underestimating the scale and scope of what this tech trade looks like.
Carol's going to jump into the conversation.
Dan, let's talk about specific stocks here. I know you love Apple because you say 2026 is going to be the year when it comes to the AI revolution, and one time is going to be a game changer. Elaborate on what you foresee for the company next year.
Look, I think that you're seeing massive changes within Cupertino. I mean, they're ripping the Band-Aid off in terms of what we're seeing from a culture perspective. You've seen changes to the top, which they needed to, right? I think that's been part of the frustration. The last events at Apple Park, I felt like Michael J. Fox in Back to the Future. Because they're just really not going anywhere. Now, it's all about Google Gemini. That's going to be a key partnership. Then ultimately, you're going to see probably a paid subscription service as they launch into the spring. And you have the biggest install base in the world. Monetization is going to be key for Apple. The consumer AI revolution runs through Cupertino.
So how much upside is there in the stock? Currently it's sitting at 277. What's your price target?
350, but look, I think if they get this right, you could have a 4 in front of it. I think that's ultimately where we see Apple heading as this all plays out, because when you start to put the monetization of AI and you put numbers together, I think it's $75 to $100 per share that AI adds to Apple. And look, it goes back to Google, right? I mean, you go back 6-9 months ago, everyone's like, AI is going to ruin their business model. They're on the defensive, back against the wall. Now look at it, right? And I think it just speaks to how quickly this tide could turn.
In terms of that tide turning, some people are saying that the launch of Gemini, the latest edition of Gemini, the latest launch, was actually a bigger moment than the DeepSeek moment at the start of the year, because it really put Alphabet on the front foot again, and it's suggesting that they've leapfrogged the other leader in this space, arguably OpenAI. And we've heard that OpenAI has now, initiated code red at the company to basically step up their efforts and not let Gemini get ahead and lose market share. When we spoke last time, you said OpenAI could be looking at $1 trillion valuation if they were to come to market near term. How do you think about OpenAI now, and what's the right valuation?
Yeah, look, it's all in OpenAI's world. Everyone else is paying rent. No, look, Alphabet, they have made massive changes. We're seeing a lot of success coming out of there. But this is an AI arms race. And at the top of that mountain continues to be OpenAI, ChatGPT. But it comes down to, like, the reason they're taking stakes, just like you're seeing Jensen, Nvidia, you're building out the stack across the board. So I don't view it as a circular financing red flag. I mean, this is an arms race in terms of, from chips to software. And you're not just going to have one winner. You're going to have many winners in this. And I think it speaks to our view that this tech bull market spreads to other areas of this tech ecosystem.
Does $1 trillion market cap still seem right for OpenAI?
I think that's probably conservative as we look at once it would go public over the next few years. When you look at where they could actually go, what numbers could look like, and then you start to think about $3 to $4 trillion being spent next few years, $4 to $5 trillion being spent over the for next 5-6 years. And look, for the first time in 30 years, the U.S. is ahead of China when it comes to tech. I mean, me and you've talked about it, that's very important. For many years, U.S. is way behind. Now, for the first time, you're ahead with the AI revolution.
Then from AI, we talk about the chips, we talk about applications and models such as Gemini, but there's also the application of AI. And when we think about that, we often think about Tesla, with autonomy, with the promises on robotics, driverless cars, etc. A lot of investors are going to be looking at Tesla 2026 in an environment where there is continued competition from the Chinese in EVs, but also those promise areas, autonomy and robotics. You are seeing very big advancements over in China as well. What is your outlook for Tesla next year, given some of these competitive factors?
I think it's going to be a magical year for Tesla, because in my view, it all leads now, and especially Musk being wartime CEO with the pay package, really autonomous and robotics. That's the future. Autonomous is worth $1 trillion alone to the Tesla story. Now look, is there competition? Clearly, you've seen it in China, but the reality is globally, I don't think anyone can match what Tesla's going to do, especially with the robotaxi build out and where I see them, especially when it comes to Optimus and humanoid robots. So look, I think Tesla, along with Nvidia, those are the two best physical AI plays in the market.
Dan, let me ask you about Microsoft. I know this is one of your top picks. What's the rationale?
I mean, on the enterprise, they continue to be the core beneficiary on Azure as companies ultimately move to the cloud, but especially when it comes to AI. I mean, I think Microsoft here, as well as Oracle, I mean, those stocks have gotten way hit, I think overdone. Look, Microsoft, I think, we've talked about this is 30-40% upside from here. I think investors are underestimating just how the penetration story is going to look like when it comes to AI. And I think monetization, look, Nadella is playing a different game. Jensen's playing a different game. I mean, you start to look at some of these CEOs, what Karp's doing to Palantir, that's the separation. And I think no one really benefits more than what we see up in Redmond.
Dan, in terms of the hyperscaler sort of landscape, there's this view that Amazon somewhat has fallen behind the likes of Google and certainly Microsoft with Azure. But we saw in the latest quarter there are signs of kind of revival at that core AWS business. Can Amazon keep pace with those rivals?
Yeah, and look, Anthropic's is going to be a key beneficiary, as they play with them in the sandbox. But look, Jassy's an AWS guy. I mean, look, when he took over Amazon, clearly had a lot of, I think a lot of issues from cost cutting, and they definitely had structural problems. Now, you're starting to see them get their sea legs. I think that's a huge beneficiary. I think, look, some of the parts, just like we talked about with Google, you could see some of the parts, Amazon, the AWS, that could add, you could say conservatively, another 25-30%. But it speaks to the view, like on the hyperscalers, you cannot view it like it's done. You have to view it like only 3% of companies in the US have gone down the AI path. 0 in Europe, ex-China and Asia, very small. Sovereigns are just starting, especially with Middle East. That speaks to where we are. I mean, this is, like I said, this is early days in this AI revolution.
Let me take you to this week. We've got a pretty big set of numbers coming out from Oracle after the close tomorrow. And Oracle has emerged as a way for investors, it seems, to play out the bear thesis on tech. If you're worried about the tech trade, then you might look to CDS, you might look to Oracle bonds here. To what extent do you think that Oracle could prove a risk event for the tech trade and for wider markets this week?
Yeah, look, and the bears, they'll pull any mathematical gymnastics, right, and yell fire in a crowd theater. Oracle, I think, is a table bounder relative to where I see that stock today. And you look, relative to OpenAI, it's like, okay, now good is bad because you're associated with them. And see, I disagree. I'd rather, could you have too much Peter Luger stake? The point is, I view it that is a beneficiary for them to actually be with OpenAI. And I think Oracle, when it comes to the stack, they're as well positioned as anyone. And I would not bet against Ellison.
Right out of the gate, the segment frames this around a partnership designed to speed up AI-driven engineering. The headline claim is that workloads that used to take weeks could get cut down to hours. That is a big statement because it moves AI from being a cool demo to being a direct productivity lever. When you hear weeks down to hours, think of the downstream impact, shorter product cycles, faster design iterations, and companies being able to ship new chips, new systems, and new software faster than competitors. Markets tend to reward that kind of advantage because it compounds. If you can compress development time, you can potentially compress time to revenue, time to market share, and time to better margins. Then, you see the immediate market reaction. Nvidia up about 1.5%, Synopsys up nearly 5%. That matters because it tells you how investors are reading the deal. They are treating Nvidia as the central infrastructure enabler, and they are treating Synopsys as one of the key picks and shovels beneficiaries that can plug into Nvidia's platform and sell more into a world where AI is now embedded in engineering workflows. Synopsys is not a random name in this conversation. This is exactly the type of second-layer company that benefits when the AI spend broadens beyond just buying chips. Now, when the hosts ask him to define the tech sector to where he narrows it quickly, he points to big tech and the Nasdaq, and specifically the Mag 7 names as a core piece of that. That is important because he is essentially saying, if you want to understand 2026 upside, you cannot ignore the largest platform companies because they are both the builders and the buyers in this cycle. They are spending the most, deploying the most, and in many cases selling the most AI-driven products and services. But then he goes further and says big tech in the AI trade could be up anywhere from 20 to 25%, and that the AI revolution stocks, what he calls the winners, are up 20% minimum. The way I hear that is, he's creating a base case for big tech, and then he's implying there is a subset of AI-linked names that could do even better because they are more directly tied to the incremental dollars being deployed. And the key phrase he repeats is this being the next stage of the AI revolution. That is his framework. He is basically saying, we are not at the end of the story. We are transitioning from the first stage, which was proof of concept and early infrastructure, into the stage where deal flow accelerates and monetization starts to show up more visibly. He mentions checks, and that is Wall Street speak for channel checks, conversations with customers, partners, CIOs, procurement teams, and the broader supply chain. In other words, he is not just looking at headlines, he is claiming the demand signals are showing up in real conversations and real budgets. And he says that even in the last 3 to 4 weeks, about 20 to 25% of deals have actually accelerated from the hyperscalers. That sentence is one of the most important sentences in the whole clip. Hyperscalers are the giant cloud and platform players that spend enormous amounts on data centers and infrastructure. If deals are accelerating from hyperscalers, what that implies is urgency. It implies competitive pressure. It implies they are trying to outbuild each other, out-deploy each other, and lock in customers with AI capabilities. When hyperscalers accelerate, the whole supply chain feels it. Chips, networking, servers, storage, power, cooling, software tooling, security, and data platforms. That is why he immediately expands the conversation from software to cybersecurity to infrastructure. He is telling you the AI cycle is broadening, not narrowing. And then he says something that is basically his core thesis. This is just the beginning of the monetization of the AI revolution. In plain terms, he is saying, the spending wave is not the end goal. The end goal is revenue generation, pricing power, and profit expansion from AI-infused products and services. He is suggesting that the market is still underestimating how much money will be made once AI becomes embedded into enterprise workflows and consumer platforms at scale. Then the interview pivots into a skeptical question, and I like that they asked it because it addresses something a lot of investors quietly worry about. They ask about Nvidia investing in a partner that is basically a customer. In this case, the framing is that Synopsys will use CUDA and become a paying customer. So Nvidia is investing about $2 billion in stock to gain this customer at some point. And the host is basically saying, is this normal strategic investing or is this a red flag? Dan Ives responds by pulling a comparison from the late 90s, vendor financing. That reference is loaded. Vendor financing became a dirty phrase because it can create an illusion of demand. If a vendor is effectively funding the customer so the customer can buy the vendor's product, revenue quality gets questioned. It can raise the fear that demand is being pulled forward artificially or that the vendor is manufacturing growth. He does not dismiss that concern. He says yes, obviously worries, red flag, but then he reframes it as an AI arms race. That phrase, AI arms race, is doing a lot of work. What he means is, the strategic value of locking in ecosystems, platforms, and developer mindshare is so high that these companies are willing to spend aggressively now to secure dominance later. He groups Nvidia with OpenAI and then mentions AMD and others. He is painting a picture of multiple giants planting flags and building moats, and then he gives a very punchy claim. For every dollar they spend, they are getting back $8 to $10. That is essentially an ROI argument, and it is also a signal of confidence. He is saying yes, in the near term there could be questions, and the optics can look strange. But he expects that when you zoom out 2, 3, 4 years, the strategic payoff will look obvious. This is also where he goes all in on Nvidia's positioning. He calls Nvidia the one chip in the world fueling the AI revolution and says he does not see that slowing down. Whether you agree with the absolute wording or not, the underlying point is that Nvidia has become a platform, not just a chip provider. CUDA is not just software, it is developer lock-in. It is ecosystem gravity. And in platform businesses, you sometimes see aggressive moves that look expensive up front, but are designed to strengthen the flywheel. More developers, more tools, more partners, more workload optimization, more demand for the underlying hardware. He also explicitly says he loves everything Jensen is doing, which is a very clear signal that his read on Nvidia is not just about quarterly numbers. It is about leadership strategy, positioning, and long-cycle dominance. Then they discuss the market reaction again. One host says they were surprised Synopsys did not trade better, especially considering the stock had fallen hard from around 650 down to around 420 in a straight line. The host is basically saying, if you are an $80 billion company and Nvidia is taking a $2 billion stake, why is the market not throwing a bigger party? Dan Ives agrees he is surprised the stock did not trade higher, but he uses that to set up an opportunity narrative. He brings in Oracle as an example, referencing a $100 dip and the weird market psychology around being associated with Nvidia and OpenAI, where it can be viewed as good or bad. The point he is making is that sometimes the market reacts in a conflicted way. Excitement about AI exposure, but anxiety about valuation, dependency, hype, or execution risk. That mixed reaction can cap the near-term upside, even when the long-term story is strong. And then he drops a phrase that is extremely important for how he invests. Second, third derivatives of the AI revolution trade into 26. Translation: the easy trade was owning the obvious leaders early. The next trade is owning the layers of companies that benefit because they are essential enablers, tools, and platforms that ride the spending wave as it spreads outward. This is where a lot of investors either make money or miss the move. The market's first instinct is always to crowd into the most visible winners, but as the cycle matures, the beneficiaries expand into adjacent categories. In this case, Think of companies that help design chips, secure AI workloads, orchestrate enterprise deployments, manage data pipelines, optimize cloud usage, and integrate AI into existing corporate systems. If hyperscalers are accelerating deals, those derivative beneficiaries can see demand inflect as well. Then the conversation shifts to Palantir, which is an example of how polarizing this trade can get. The host points out Palantir has been hammered right after earnings, and then asks the key question: do you buy it here, given how expensive the valuation is and how outsized it looks? Dan Ives does not just say, double down, he says, triple down. That is his style. He is intentionally emphatic, because he wants to communicate conviction even in the face of volatility and valuation discomfort. And he acknowledges the obvious pushback. He gets that it is expensive today. But then he makes a big forward-looking claim. In the next 2 or 3 years, he thinks there is a path to a $1 trillion market cap. Now, whether that happens or not is a separate debate, but what matters for understanding his thesis is the reasoning he gives. He argues that trillions of dollars are being spent on AI use cases, and he believes Palantir is positioned to capture a meaningful share of enterprise AI deployment, almost like the first call for enterprises trying to operationalize AI at scale. That is the crux of the Palantir bull case he is presenting. Not that AI is exciting, but that enterprises need a partner to translate AI into real operational systems. If you believe Palantir is becoming a core layer in enterprise AI adoption, then you can argue the market may still be underestimating the long-term revenue potential, even if the stock looks expensive in the short term. And when he says it is still not reflected in the stock, he is basically claiming that the market is focused on valuation today and not on the magnitude of future deal flow. That is a classic growth investor framing. Short-term multiple compression can happen, but long-term TAM expansion and execution can outgrow the multiple over time. Now, stepping back, what is Dan Ives really telling you across this entire clip? He is telling you that the AI cycle is not slowing, it is broadening. He is telling you the biggest buyers, the hyperscalers, are accelerating deals right now, which suggests urgency and competitive pressure. He is telling you that monetization is in early innings, meaning the revenue and profit impact has room to expand. He is telling you Nvidia is still the central force in the infrastructure layer, and he is comfortable with aggressive strategic moves because he sees them as reinforcing a platform moat. And he is telling you there are opportunities beyond the obvious leaders in second and third layer names that can benefit as AI becomes embedded into real workflows. At the same time, if you are listening carefully, he is also indirectly acknowledging the risks. When vendor financing comes up, he admits it can be a red flag. When Synopsys does not trade as high as expected, he admits the market can be conflicted. When Palantir valuation comes up, he admits it is expensive. None of that stops his conviction, but it tells you he understands what the skeptical case is, and he is choosing to lean into the long-term view anyway. My own reaction is this. This is exactly how high-conviction analysts talk when they believe a structural trend is bigger than the near-term noise. They anchor you to a timeline. They keep pulling you forward 2, 3, 4 years. They focus on platform lock-in, ecosystem building, and budget acceleration, and they treat volatility, sell-offs, and muted reactions as opportunities rather than warnings, as long as the fundamental demand signals are still pointing up. The practical takeaway for your portfolio mindset is not that you blindly chase anything with the letters AI in it. The takeaway is to pay attention to where the spending is coming from and how it is spreading. If hyperscalers are accelerating deals, then infrastructure demand has a tailwind. If engineering workflows are being compressed from weeks to hours, that is productivity that companies will pay for. And if monetization is still early, that means the market may continue to re-rate winners as revenue and profit show up more clearly. And the final point, especially if you are watching this as a retail investor, is that Dan Ives is essentially describing 2 games happening at once. One game is the quarterly market game, where stocks react to earnings, headlines, and valuation anxiety. The other game is the multi-year platform and adoption game, where the winners are the companies that become the default rails for how AI is built, deployed, and secured. His whole message is that the second game is the one that will matter most into 2026, and that is why he is willing to stay aggressive even when the tape gets choppy. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the top 4 AI stocks to buy right now. First up is Broadcom. ticker 𝗣𝗟𝗏, a company that's absolutely critical to the AI ecosystem, even if it doesn't always grab the headlines like some of the flashier names in tech. While you might not see Broadcom's name splashed across the news every day, its technology is quietly powering the backbone of the digital world, especially as artificial intelligence continues to reshape industries. AI models are growing at an unprecedented pace, and with that growth comes a massive demand for moving data between servers at lightning speed. These models require enormous amounts of information to be transferred, processed, and analyzed in real time. If that data can't move quickly and efficiently, the entire AI operation grinds to a halt, no matter how powerful the processors are. This is where Broadcom steps in. The company designs and manufactures the high-performance networking chips and custom ASICs that keep AI data flowing seamlessly. These chips are the unsung heroes, acting as the highways and bridges that connect the different parts of a data center, ensuring that information gets where it needs to go without bottlenecks or delays. Tech giants like Google and Meta, who are at the forefront of AI innovation, rely heavily on Broadcom for custom chips tailored to their unique and demanding AI workloads. These partnerships aren't just about buying off-the-shelf products. They're about deep collaboration to create solutions that push the boundaries of what's possible in AI. Broadcom's networking switches, such as the Tomahawk and Jericho series, have become industry standards in data centers that are being retooled for the AI era. These switches are engineered for ultra-low latency and high throughput, which are essential for training and running large-scale AI models. Once a company builds its infrastructure around Broadcom's technology, switching to a competitor is not only technically challenging, but also extremely costly. This creates a powerful moat around Broadcom's business, locking in customers for the long term and making it difficult for rivals to break in. The recent acquisition of VMware has taken Broadcom's capabilities to a whole new level. Now Broadcom can offer both the hardware and the software that enterprises need, providing a seamless, end-to-end AI infrastructure solution. This integration means customers can manage, optimize, and scale their AI workloads more efficiently than ever before. This synergy between hardware and software makes it even harder for customers to leave Broadcom's ecosystem. The more integrated their solutions become, the more value they deliver, and the more sticky their customer relationships are. While other companies focus on building the most powerful GPUs, Broadcom is focused on building the superhighways that connect all those GPUs together. Without these high-speed connections, even the best AI chips can't reach their full potential. Financially, Broadcom is a powerhouse. The company has delivered consistent revenue growth, maintains high profit margins, and rewards shareholders through regular dividends and share buybacks. Its balance sheet is strong, giving it the flexibility to invest in R&D and strategic acquisitions. At the helm is CEO 𝗗𝗓𝗏, who's widely respected for his operational discipline and a track record of smart, value-creating acquisitions. Under his leadership, Broadcom has become known for its focus on efficiency, profitability, and long-term vision. It's true, Broadcom's stock isn't cheap, but what you're paying for is a dominant, high-quality business with direct exposure to the explosive growth of AI. In a world where AI infrastructure is becoming more critical by the day, that kind of market position commands a premium. Of course, there are risks. The pace of AI build-out could slow, or a new competitor could emerge with disruptive technology. But Broadcom's deep relationships with customers, its engineering talent, and its entrenched position in the market make these risks less likely to materialize in the near term. Customer concentration is something to watch. Broadcom does rely on a handful of major clients. However, the addition of VMware's enterprise software business helps diversify revenue streams and reduce dependence on any single customer or sector. In short, Broadcom is a high-margin, essential business that sits right at the heart of the global AI infrastructure build-out. Its products are foundational to the next generation of computing. Think of Broadcom as a classic picks and shovels play, selling the tools and infrastructure that every company needs to participate in the AI gold rush, regardless of who ultimately wins the race for AI dominance. For me, Broadcom's dominance in networking, its expertise in custom chips, the strategic integration of VMware, and its financial strength all combine to make 𝗣𝗟𝗏𝗧 a compelling long-term investment for anyone looking to benefit from the AI revolution. As long as AI continues to grow and evolve, Broadcom will be there, powering the infrastructure from behind the scenes and enabling the next wave of technological breakthroughs. Next up is Alphabet, Google, ticker 𝗗𝗏𝗓𝗏. Everyone knows Google, but the company is so much more than just a search engine. It's a global technology leader, shaping the way billions of people interact with information, entertainment, and even the physical world around them. While most people associate Google with search, its AI integration runs far deeper than most realize. AI is woven into the fabric of nearly every product and service Google offers, from the algorithms that power your search results to the smart suggestions in your email inbox. Google Search itself is powered by some of the world's most advanced AI, understanding not just the words you type, but your intent, delivering relevant answers in milliseconds. This technology is constantly learning and evolving, making search more intuitive and personalized with every query. Beyond search, Google Cloud Platform is growing rapidly, offering a suite of AI and machine learning tools that attract companies of all sizes. Businesses are increasingly relying on Google's cloud infrastructure to build, train, and deploy their own AI-powered applications, fueling innovation across industries from healthcare to finance. The synergy between Google's products, Search, YouTube, Android, Maps, and more, creates a massive data advantage. This interconnected ecosystem allows Google's AI to learn from billions of daily interactions, making its algorithms smarter, more effective, and uniquely positioned to anticipate user needs. At the heart of Google's AI push is DeepMind, its world-renowned research arm. DeepMind has delivered breakthroughs like AlphaGo, which defeated the world champion at Go, and AlphaFold, which solved complex protein folding problems. These advances aren't just academic, they're now fueling real-world products through Google's Gemini models. Gemini is Google's answer to GPT-4, a next-generation, multimodal AI that can process and understand text, images, audio, and video. This technology is designed to be flexible and powerful, opening up new possibilities for how we interact with information and digital tools. This cutting-edge AI is being infused into everything Google touches. Workspace apps like Docs and Gmail, the Google Assistant smart speaker in your home, and even Waymo, Alphabet's self-driving car company. The goal is to make every interaction smarter, more helpful, and more seamless. Waymo in particular is quietly leading the race in autonomous vehicles, with millions of driverless miles already logged on public roads. Waymo's technology is setting the standard for safety and reliability in self-driving transportation, a market with enormous long-term potential. Meanwhile, YouTube's recommendation engine, powered by sophisticated AI, keeps viewers engaged and drives massive ad revenue. Every video you watch, every click you make, helps refine the algorithms that keep people coming back for more. Alphabet's core business, digital advertising, remains a cash machine, generating the profits that fund its most ambitious AI projects and moonshot ventures. This financial strength gives Alphabet the freedom to invest in long-term innovation, even as it faces new challenges. The company's valuation is reasonable, especially when you consider that investors get a dominant ad business, plus AI-driven growth in cloud, Waymo, and DeepMind. Alphabet's diverse portfolio means it's not just betting on one technology, but building multiple engines for future growth. Of course, there are risks. Regulation is a big one. Alphabet faces ongoing antitrust scrutiny in the US and abroad, and new rules could force changes to its business model or limit its ability to leverage data. Competition is fierce too. Microsoft and OpenAI are pushing hard in the AI space, and Google must prove that Gemini and its other innovations can lead the next wave of AI development. The race for AI dominance is just heating up. Execution is key. Google has sometimes struggled to commercialize its most promising innovations, and not every moonshot pays off. The company must stay focused and agile to turn its research breakthroughs into real-world products that people use every day. But with unmatched data, world-class talent, and vast resources, Alphabet is uniquely positioned to be a dominant force in AI for years to come. Its ability to attract top engineers and researchers combined with its global reach gives it a powerful edge. Don't overlook this tech giant. Alphabet is far more than a search engine. It's an AI powerhouse with multiple growth engines just getting started, and its innovations are likely to shape the future of technology for decades ahead. Third is Taiwan Semiconductor Manufacturing Company, ticker TSM. This company is the backbone of the global semiconductor industry. TSM doesn't design chips, it manufactures them for giants like Apple, Nvidia, AMD, and Broadcom. It's the only company that can reliably produce the world's most advanced chips at scale. Think 5-meter, 3-meters, and soon 2-meter. Without TSM, the AI revolution would grind to a halt. Their technological lead over Samsung and Intel is years ahead, giving them huge pricing power and a massive moat. All major AI chips, Nvidia's H100, Apple's M-series, AMD's CPUs, are made by TSM. As demand for AI chips explodes, TSM's advanced packaging capacity is sold out for years. Financially, TSM is rock-solid strong balance sheet, steady growth, and a reliable dividend. The big risk? Geopolitics. TSM is based in Taiwan, and tensions with China create uncertainty. That's why the stock trades at a discount despite its dominance. TSM is diversifying, building new fabs in the US, Japan, and Germany to reduce geographic risk. The semiconductor industry is cyclical, but AI-driven demand could make growth more stable. If you believe the geopolitical risk is manageable, TSM is a rare chance to own a monopoly on the world's most critical manufacturing process, at a discount. In summary, TSM is the indispensable foundation of AI and modern tech. If you can stomach the risk, it's a unique way to invest in the future of AI. Finally, we have Nvidia, ticker NVDA, the face of the AI revolution. If there's one company that truly embodies the explosive growth and excitement around artificial intelligence, it's Nvidia. Over the past decade, Nvidia has transformed from a niche graphics card maker into the backbone of the world's most advanced computing systems. Nvidia created and now dominates the AI hardware market thanks to its GPUs. These chips are the engines powering everything from self-driving cars to massive language models like ChatGPT. Their hardware is the gold standard for anyone looking to train or deploy cutting-edge AI. Originally built for gaming, their GPUs turned out to be perfect for AI's heavy math. The same parallel processing that made them favorites among gamers also made them ideal for the complex calculations required by neural networks. This unexpected crossover changed the company's destiny. CEO Jensen Huang saw the potential early, launching 𝗗𝗜𝗦, a software platform that made Nvidia's chips the go-to for AI developers. 𝗗𝗜𝗦 allowed researchers and engineers to unlock the full power of Nvidia's hardware, making it easy to write code that runs blazingly fast on their GPUs. This move was a game-changer, cementing Nvidia's place at the heart of the AI ecosystem. Today, Nvidia owns about 95% of the AI training GPU market. Their chips are everywhere, in cloud data centers, research labs, and the world's fastest supercomputers. If you're building AI, chances are you're using Nvidia. Their H100 and Blackwell B200 chips are the gold standard. These aren't just faster, they're smarter, more efficient, and packed with features designed specifically for AI workloads. The H100, for example, is the chip behind many of today's most advanced AI models, while the Blackwell B200 is already setting new records for performance. Demand is so high that tech giants are scrambling to buy as many as they can. Companies like Microsoft, Google, Amazon, and Meta are in a race to secure Nvidia's latest chips, sometimes waiting months for delivery. This insatiable demand is driving Nvidia's revenue to new heights. But Nvidia's real moat is software. 𝗗𝗜𝗦 has locked in a generation of AI developers and made switching to competitors extremely difficult. The ecosystem around 𝗗𝗜𝗦 is massive, with libraries, tools, and a huge community of experts. This network effect means that even if a rival makes a faster chip, developers are reluctant to leave the familiar Nvidia environment. Even if AMD or Intel make a better chip, the ecosystem and developer loyalty keep Nvidia on top. The company's deep relationships with researchers, universities, and enterprise customers create a powerful feedback loop. Nvidia hardware gets better, more people use it, and the ecosystem grows even stronger. Nvidia isn't just about chips. They're building full AI supercomputers, networking tech, and integrated systems. Their DGX systems are turnkey solutions for companies that want to deploy AI at scale, and their networking products ensure data moves at lightning speed between GPUs. Their full-stack approach, hardware, software, systems, networking, delivers unmatched performance and keeps competitors at bay. By controlling every layer of the stack, Nvidia can optimize for speed, efficiency, and reliability, making it nearly impossible for others to catch up. Growth is staggering. Data center revenue up 400% year over year, with demand still surging. Investors have taken notice, and Nvidia's market cap has soared, making it one of the most valuable companies on the planet. The big question is valuation. Nvidia's stock is expensive, and any slowdown could hit hard. With so much optimism priced in, even a small hiccup in demand or a new competitor could send the stock tumbling. Investors need to weigh the incredible growth story against the risks of high expectations. Risks include competition from AMD and custom chips from big tech, but Nvidia's pace of innovation and software moat are tough to beat. Companies like Google and Amazon are designing their own AI chips, but so far, none have matched Nvidia's combination of performance, ecosystem, and developer support. CEO Jensen Huang is a visionary, always staying steps ahead. His leadership has kept Nvidia nimble and aggressive, constantly pushing the boundaries of what's possible in AI hardware and software. In short, Nvidia is the undisputed king of AI. Their relentless innovation, dominant market share, and deep software ecosystem make them the company to beat in this space. If you want direct, high-octane exposure to the AI boom, This is the stock to watch. Nvidia's story is still being written, and as AI continues to reshape the world, they're poised to remain at the very center of it all. So there you have it. 4 companies, each playing a unique, critical role in the AI revolution. From Broadcom's connectivity, TSM's manufacturing, Alphabet's digital reach, to Nvidia's hardware and software dominance, each offers a different way to invest in AI's future. The key is understanding why their positions are so defensible and why they're poised for growth. Want deeper analysis and exclusive stock tips? Join the StocksGalore Patreon, link in the description. Now, if you had to put $10,000 into just one of these for 5 years, which would you choose and why? Drop your pick in the comments. Don't forget to like, comment, and subscribe for more investing insights. Thanks for watching. See you in the next one.